Great, thank you. So we'll continue our discussion. We thought it'd be interesting, again, to continue the discussion with some additional participants. You heard Mike's story on how SoFi got started. We have a couple other companies that are attacking the space from, again, unique vantage points. We have Antonio De Sorrento from Pave, who comes to this industry by way of Sally May. He's general counsel of the company, and it's one of the first few people who I've talked about on the legal side who talks about the industry with as much passion as the CEO. So I think we'll have a fun conversation. We also have David Klein, founder and CEO of Common Bond. David's got experience in the industry at American Express, ran a $250 million annual portfolio. Again, with him and his co-founders, they also have a unique approach to the business. And then last but not least, we have Lekit Lokesh from Barclays. You heard Mike talk about tireless work at Barclays, and talking to Lekit, it became clear he's been the champion in terms of the space within the Barclays institution. So we thought it'd be useful to get his perspective on the industry as well. So with that, let me have maybe Tony, you can start talking about a little bit about, just introduce the Pave, and then same thing with David, and we'll continue from there.
So Pave.com is a recently launched startup. We connect people directly and fund them for productive things. So it's not a consumption lending. But we connect these people directly, the backer and a prospect, as we call them. And in exchange for upfront money and mentorship, a prospect returns back a % of their income to backers. So there's an alignment of interest and a risk sharing that's unique, or distinct from what you'd have between a lender and a borrower. It has unique regulatory needs, which is why this is being handled by startups. But it's a model that's attractive to lots of people, and it's better than debt for lots of people. And we see a precedent for it in the federal income-based repayment program, and also with things like partnerships or joint ventures between companies. But at Pave, we fund people, not projects or companies, again, in a unique human-to-human way. So I would say at a peer-to-peer lending conference, we are truly human-to-human, natural person to natural person at Pave. And this came about, I mean, it's an idea that's been around a long time, discussed many times, attempted many times by other companies. The Pave's founders met working together in London, had a personal experience where somebody wanted to borrow money, and my CEO, Sal LaHood, said, I don't want to be your lender, I'll be your partner. I'll invest in you. And they had a successful outcome. It made them think this should be something that's made available to more people. And that's why we exist at Pave.
Right. Okay.
David Klein, co-founder, CEO of Common Bond. We are a student loan crowdfunding platform. We launched our first program in November 2012 at an institution that where I met my co-founders, Wharton Business School. Launched a $2.5 million program there. This year, we're looking to launch, and in fact have started building presence in a number of different schools to disperse as much as $100 million. We believe, I think Mike did a great job setting the stage for the kind of opportunity that exists with respect to not just student loans, but all different sorts of credit. And I think he laid out well why student loans make sense to go to first. Now, it just so happens, for me and my co-founders, it was a personal pain point. We came to this because we felt the pain of student loans. The high cost, high fixed cost is unnecessary, particularly for credit-worthy borrowers. And we thought, well, there are other people who experience the same problems, so we decided to do something about it. And so that's what we decided to do. I think, and maybe the conversation gets here, but I think the really interesting conversation, in addition to, there are these equity models that are starting to develop, like Pave. There are these debt models that are starting to develop, like Common Bond, like SoFi. In addition to the equity debt conversation, I think there's a conversation around community. And again, Mike had mentioned it. The point is not who's going to build community. Everybody's going to build community. We're all building community. I think the key is going to be, and really the jury's still out just because the industry is so nascent, who's going to build the community that people want to belong to? Because at the end of the day, particularly for a two-sided market, in our case, we have lenders on the investment side, we have borrowers on the borrowing side. Both sides of the market want to find a value. They want to be part of a community that provides value. For the investors, it's that optimal risk-return dynamic. For the borrowers, it's what is that community that's going to actually help me succeed, not just minimize my personal expense line and save me, call it $20,000, $25,000 on my loan, but my personal top line as well. Who can I connect with? Who can help facilitate my professional success? And that's something that we're very focused on at Common Bond, because that's where we think true differentiation happens in this space that is emerging and new.
Well, I think the three of the four panelists have talked a lot, touched on in the community, what I would say the return on emotional capital or affinity capital. Like from your point of view, when you started to champion this space in the context of Barclays, can you talk a little bit about how you looked at it from your dollars and cents point of view, and how you look at the opportunity from Barclays?
Yeah, I mean, I'd like to touch on something that Debbie Klein said early on. This is a $1 trillion market. It is growing to be one of the federal government's biggest issues. Every weekend before Eugene and I, who's on my team, would launch a Sallie Mae deal, a New York Times article would come out about some student with debt. So it's a large environment. There are going to be a number of players playing in it now and in the future. That's why we're excited about it, I think, going forward, in particular the peer-to-peer space. But I think one thing that we have to think about the student loan market is when you're looking at it, so I started covering the space in '06, and I had a vibrant client list of 30 companies that you could cover, and the federal government came into place and quickly took away each 10, 15 of those guys, and then it was like down to 5. So I was thinking, well, the federal government can't provide all the opportunity in the space, all the funding in the space. There has to be someone else. So, I mean, obviously Common Bond and SoFi are there. But I think of it almost like a food situation, right? So you come to a nice restaurant, you get the appetizer, right? And you get the entree. That's kind of SoFi and Common Bond. And then you get the dessert, which is Pave. But before that's the appetizer. And the problem with student loans right now, and what I've covered for a long time, is the fact that a lot of kids are coming to school, they're getting their student loan, but then they're charging everything on their credit card, and they're racking up a large number of a large amount of debt at a high interest rate. So there's other startups too that are not here, but are definitely very vibrant in New York, also in out west, and they're called Campus Slice and they're called Instagrad, and they should provide those smaller loans. But definitely Common Bond, SoFi, Pave, Sallie Mae, and even Discover will be a large part of this discussion. So that's why I wanted to cover this space, is I feel like it's dynamic. I feel like we can use a lot of our human capital, which we have a ton of, and less of kind of the sluggish lending capital, which we eventually we'll get to. But I think that's where we felt like we could add the most value to this space.
Just continuing, you talked about the government. I mean, in this sector more than any of the others is obviously massive. There's also huge political imperatives and priorities as well. And each one of you have kind of found your own path through this. Maybe we should. I'd love to get additional thoughts around that. What keeps each of you awake in terms of that aspect of the pictures over the next 2 to 3 years?
Sure. I think there's two big exogenous risks that you have in student lending. The first premise is the reason the opportunity exists is because the government has a set of fixed rates that for a certain borrower segment is too high. And the issue is that as rates back up and they go higher, the margin or the differential between where market and where those government rates are compresses. And so the question is, at what point do those things intersect? And so we always have a macroeconomic risk that's overarching. But we also have an exogenous policy risk. So a lot of the policy decisions that are being kicked around right now, modifications of student lending programs, would be very restrictive to our businesses because they would substantially lower the rates to the point where our margins wouldn't be there. And so the one mitigating factor you have on this is the way that the government accounts for student loans is they take the loan coupon and they discount it at the match maturity treasury rate. And so when they do $100 of loans, of grad plus loans, for example, it looks like they're making $50 of profit. And they book that as revenue into the budget line, even though there's no cash. So if you were investing in the government, you would short them because they show tons of revenue with no cash flow. But the challenge that they have is that amount goes into the budget as a budget line item. So to the extent that it's modified or it's reduced, they have to make up for that through either reduction in spending or increases in taxes. So there are reasons to believe that if rates back up, the government would be in a position where they'd have to actually force that rate higher. Or conversely, policy decisions that are being announced now that would substantially lower the rate would force other action, whether it be taxes or expenditure cuts, that would have to occur to keep that balance. So there's some mitigation to the government factor. There isn't a lot of mitigation to the overall macro risk other than the government having to move the rates and rates rise.
Just one thing to add on top of that. In addition to the fact, I mean, well, Mike, what you're talking about is why that likely won't happen, right? As to what the federal government has to do in order to make it happen. I think there's also the possibility of, well, what happens if it does happen, right? Just for political factors that we can't control. And to answer that question, if you look at the bills in Congress right now, and there are about 6 of them flying around, they really fall into 2 buckets. One is a group that I don't think anyone takes seriously, what I will call constituency bills, ones that lower the rate so much to make a political point. And then the other bills in Congress are what I would call more serious policy bills. And those bills will in fact lower the student loan rates as to what they are right now. But if you run, and we've modeled each of these bills through a number of different scenarios relative to our rates, not only are we still slightly competitive with the rates, but I think it actually goes back to this important point of differentiation, which is community, right? I think the way we think about not just student loans, but lending in general is going through monumental change in a way we won't fully understand for another 5 to 10 years. And a large part of that has to do with community and the benefits that come along with community. You know, as investors, we think about, well, what is my return? And up to this point, we've really only thought about it in terms of traditional sense of risk return. Well, we can still think about it in terms of risk return. But going forward, when you have added elements of community and what that means in terms of how you can attract even higher credit quality borrowers onto your platform, that means something. That means that you can continue to give disproportionately high rates of return for the underlying risk, which, by the way, on our platform, for example, is pristine. Right? So there are a number of different things that we can do, even if the exogenous factors, the macro factors, don't go our way, in a way that also, you know, forgive me for using the word revolutionize, but revolutionizes finance.
Actually, following on with what David said, you know, PAVE, we're very much in touch with policymakers and following everything that's going on in Capitol Hill. It's really hard to compete with the government on price when they can subsidize treasury rate, not account for cost of equity. We don't do that. So I guess at PAVE, when we look at potential policy outcomes, we think it's not great. More subsidies isn't always the answer, but PAVE use of proceeds aren't restricted to education finance, and so we don't have to just originate or connect people for subsidized products or subsidized uses of proceeds. So you can't get a student loan for everything. Additionally, there's competing on quality, and so we are definitely competing on quality. The nature of a human connection in that PAVE, you know the person's name who is funding you. It's just not present in any dumb money environment, whether it's the government or a bank.
Just before we open up for questions, I just want to follow up. I wish we had more time, actually. This is a fascinating topic. Apologize. But can you all just talk a little bit about trends in origination, cost of origination, access? It's for each of these categories, you know, what are the trend lines you're seeing in terms of origination side, in terms of vis-a-vis your industry? And then the other aspect is to touch on delinquency. Mike, I know you're very proud of your record there, but just not just what it is right now, but how you kind of see that unfolding as you look at these additional adjacent markets as well.
Yeah, I think within the context of origination, you have 2 very different dynamics within student lending. So you have in-school loans, which that's a relatively low cost point because you have a borrower base that's concentrated. You can go through the financial aid office as an alternative, as a private loan solution into that borrower segment. The challenge you have is it's a very different borrower than someone who's already graduated, who's employed, who has income. That's a very different dynamic in terms of going after that customer. And you know, to Dave's point, the whole aspect of community, and one of the big values behind it is not only does it massively improve the credit quality, we think it does address issues of adverse selection and moral hazard that I talked about earlier, but it also significantly lowers the cost of borrower acquisition. because people want to be engaged, they want to get value from that community. I think our own thinking of community has morphed pretty significantly, that originally we thought, well, the community would be connecting alumni to borrowers. And borrowers are actually alumni as well, because they're all graduates, so it's an alum-to-alum connection. And what we found is that because we're limited, because the Jobs Act is still hung up at the SEC, we're limited to accredited investors. And going out to an accredited investor and saying, look, invest $500,000 in the Harvard fund, they look at it first and foremost right now as economics. And there's a feel-good factor to it, but it's an economic component for them. Whereas the borrowers love that level of engagement. And so we've actually been fostering much more community interaction amongst the alum borrowers, where there's a lot of reason to be supportive and be helpful. And so, for example, when we got some folks jobs recently, it came through that borrower network. It didn't come from alumni who were stepping up to do it.
Anyone else want to talk about cost or delinquencies?
I can speak to delinquency a little bit. We have an income-based product, and so there's going to be people who fully perform that aren't actually delinquent, but that don't repay everything that they got. And that's, at Pave at least, we're able, unlike a debt product, we can capture some upside from people who overperform. So our hope is that there's some balance to that. But we are so young, honestly, and on cost too. We're so young and so manual that there's not great data.
Okay. So on our platform, for example, zero delinquencies, everything's current pay. I think Mike triggers an interesting point, and that is, who can put money onto the platform, and the fact that we're pretty much all limited. We're all limited by the regulation right now, right? And that's why we're going after accredited investors. Yep. And so the question is, what does the world look like, or what do we have to do now for the world that we're all going towards, particularly in peer-to-peer lending space, right?
I think we have time for all these gentlemen are going to be available in the breakout room right after this, so for additional questions. But let's take one or two questions. There are quick ones from the audience. Anybody?
Bueller.
Go ahead, Michelle.
The question for Dave, what's the age of the people who actually?
Okay, great question. So let me just rephrase this question for me. Just demographics of these. So maybe everyone can kind of touch on that. That'd be great.
Sure. At Pave, we don't have a legal age limit other than that you be of legal age. What we think it's the best use case for are people who understand what they want to be or what they want to do and know how much money they need. So it's not a great use case for an 18-year-old. It's not a mainstream product yet, so it's not perfect for an 18-year-old who doesn't know how much money they'll need for college or for whatever career they're going to be or exactly what career they're going to be. And because there's not a mainstream consciousness of a general awareness of how these work versus how loans work, it's probably not the best financial instrument for somebody to do first. So the best people for us are people who do know what they want to do, have done other things, financial products, whether it's a student loan or an auto loan or a credit card in their lives, and who know how much money they need. So that leads us into the mid-20s. I mean, if you think about people out of undergrad, people in grad school, people finishing grad school, great use case. And they can still benefit a lot from the mentorship or the example that our backers can give.
Our profile at Common Bond is about 28, 29 years old. Average FICO's north of 750. They're making on average about $120,000 a year.
Yeah, that's very similar to our average borrower. And we have close to 2,000 now. If you believe cohort default rates, we should have 8 to 12 of those folks in 90-day plus delinquency. We've never had anyone in 90 or 60 or 30. Everything's current pay.
Okay, why don't we stop here? Again, they'll be available in the breakout room. Big hand for our panelists.